and it was great to hear your insights on the E&P Growth Strategies panel here at the Stock Exchange this morning. Maybe just to kick us off, for those that aren't familiar with Onyxpoint, can you just give us a quick introduction to your investment approach? I mean, I look at it according to press releases and looking at the numbers. You're one of the best performing energy funds out there. You compounded 99% in 2021. The 2022 numbers weren't too different. It'd be great just to get an overview of your approach to market and the most, I guess, where you see the most attractive risk-adjusted returns in energy today.
Sure. We are a New York-based asset management firm that focuses across the capital structure. So we invest in everything from the top of the capital structure down. I would say also our business is somewhat different than most in the sense that we invest in both the public and the private markets. We invest in commodities exclusively, so oil, gas, infrastructure assets, power, chemicals, shipping, and sort of everything in between. You know, one of the keys to success that we've learned over the 2+ decades of having been in the sector and navigated multiple up cycles and down cycles is that if you want to be successful over the long run, you have to have an ability to deploy capital in a counter-cyclical or somewhat contrarian bet. So for us, what that means is the areas of focus tend to move around quite a bit. We came into the year last year in an environment where the public market was actually at a cheaper valuation than the private market, which doesn't happen very often, and that created its own set of opportunities that we were fortunate to take advantage of. As we sit here today, there's a lot of volatility in the public markets. There's a lot of uncertainty about recession, commodity prices, policy. And so again, our focus is try and deploy capital where others are not.
Brilliant. And I guess then to delve deeper into some of the themes that you touched on the panel earlier today, we obviously spoke about how the narrative is changing as priorities shift from energy sustainability to energy security. I mean, how is that narrative changing in your view? And what does the outlook look like, say, 3 years from now? What does that comeback look like?
You know, it's interesting because we've seen such an enormous amount of change in the last 3 years. As you heard me say, 2021 really was the bottoming out of old energy. And that was followed by 2022, which was a wake-up call after the terrible invasion of Ukraine. And we're now at a point in 2023 where we're reflecting. The pace of commodity price inflation is not what it was last year, but we're not flatlining from here either. So when you really think about how that impacts some of the dialogue around energy transition, you know, we are coming to this realization as a society, as a capital markets, that it's not just about sustainability. The narrative has to focus on sustainability, reliability, and security, energy security. I think the other thing that I think will be dispositive is coming into this winter. Europe was quite fortunate last year in the sense that we had a very warm winter. We had gas volumes that were diverted from Asia into Europe that could be used. And prior to the Nord Stream pipeline having the sort of sabotage or blow up incident, we actually had near full gas and storage. So I think as we move towards a framework where we have to rely on more sustainably secure energy, we're going to see a greater role for natural gas. We're going to see a greater role for the United States as a trading partner for Europe. And quite frankly, we will start to have to incorporate old energy into the mix going forward, albeit with a lower carbon intensity.
Yeah, no, it makes a lot of sense. And obviously, if we listen to the comments throughout the morning so far, it's all been around how productivity is falling off a cliff. I mean, what does phase 2, phase 3 look like from a shale boom perspective? Are we now moving to EOR, secondary, tertiary type recoveries? What implications is this having from a capital allocation standpoint?
Well, we're definitely up on the technology S-curve. If you think about the last 5 to 10 years of oil, it's really been about discoveries, new drilling techniques, new completion designs, downspacing. And I don't know if we're in the 6th or 7th inning, but it feels quite sort of long in the tooth. And I think that changes the business model for a lot of privately owned assets, as well as public assets on the mid-cap side. I think you're going to see a better home for a lot of these companies with bigger, more scale-oriented operators that have access to lower cost of capital. We're already seeing that. There's been quite a lot of consolidation. I think you're going to see more, very similar to the late 1990s. And I think on the private side, the model has to adapt to find a real value-added niche. And it's no longer about buying acreage and drilling it out and flipping it. I think it has to be about taking assets, as you said, that are a little bit more mature, whether they're shale or conventional, and driving cash flow and driving value from that.
Yeah, they're brilliant. And I guess the final, there's so much to unpack, and I'm mindful of time, but the final thing that I guess I'd like to pick your brain on is around the durability of the business model and actually the value creation side of things. I mean, obviously we've heard, you've alluded to the rock and the sort of tier 1, tier 2, tier 3 players. What comprises as a high quality location that someone's going to pay for, and what are the business attributes that you want to see that are going to make a business desirable and investable?
You know, the definition of what is high quality inventory is evolving. If I had to put a finer point on it today, I would say there's probably 3 or 4 attributes that define high quality inventory. The first is that it needs to compete for capital amongst the portfolios of the large public companies. And interestingly, it not only needs to compete for capital within their inventory, but now needs to compete for capital with share buybacks, because there is an inherent value to buying inventory through your own shares as you buy back your stock. So that's number one. Number 2 is repeatability. I think you'll see a much greater emphasis and value placed on inventory that a larger player can buy and develop in more for programmatic scale. Those are few and fewer in between. 3 is synergy. If you think about driving longer laterals, majors or even large independents that can buy a small operator, a mid-sized operator, and then suddenly transition to 10,000, 15,000 foot laterals, that's going to be a big needle mover. And then last but not least, it's, as I said, it's cost of capital. We had just come out of a period of essentially free money with 0 to negative interest rates for the better part of almost 2 decades. And, you know, when you do have access to capital, you're going to have a different development program. So I think people will want to buy inventory where they can see a line of sight to developing it within a short space of time.
Brilliant. Well, Shaia, again, as I say, we could talk about this for hours, but that's time. So thank you very much. I've always enjoyed catching you up.
Pleasure.
Thanks for speaking. Thank you.